level that typically a fund manager needs to consider is, firstly, I will ask them to think about at the fund level, what will be the tax implication at the fund level? And this typically ties to where the investment team is being based, and whether the investment team is based in a jurisdiction which actually offers some tax incentive for those investment funds being managed there. So Hong Kong Singapore definitely have the fund exemption regime. If the investment team is actually based in China, unfortunately China doesn't really offer any fund exemption regime for a fund that is managed in China. So you need to really consider, okay, because $1 you earned from investing into the underlying asset, what are the tax costs that would you have to pay at the fund level? And this definitely will impact the level of the fund and also the attractiveness of the fund. So that is the first consideration. Second consideration is where the fund is investing into. So what is the target jurisdiction? The reason for that is that dependent on whether your investment is, there is what we so-called the source country taxation. Say, for example, if you are investing in China, you are holding an equity interest in a China company, you receive dividend, then you will have China dividend withholding tax. You exit and earn capital gain, that could potentially be capital gain withholding tax as well. So you also need to consider the investment jurisdiction, the source country taxation, and how you structure your fund in order to minimize the source country taxation as much as possible. The third thing is definitely on the fund manager level, because from the fund manager perspective, what you earn is definitely the management fee, performance fee, as well as carry. How this income are being tested in the different jurisdiction. Management fee possibly will be tested anyway, in whether you are basing your management team in Hong Kong or in Singapore. But when it comes to performance fee or carry, will be tested. How you will be tested, at what way you will be tested. Is there ways that we can minimize the test cost as much as possible by basing the investment team in different locations? And then finally, at the investor level, the investor level is not so much talking about the investor's own home country taxation, because say, for example, if it's a US investor, it has to be tested worldwide anyway. But what we are talking about is an investor investing in your fund, will it cause adverse tax implication to them simply because your fund is domiciled in a particular jurisdiction? So these are the 4 typical level of taxation that the fund manager needs to consider.